Welcome to Tim's Strategy of the Week series. Today we're going to talk about an old strategy with a new twist. Stay right there. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of the Strategy of the Week. Today we're looking at a simple price action pattern strategy that can be very profitable, the Engulfing Pattern trading strategy, but we're adding a twist to make it even more profitable. We're going to take a deeper look into what exactly the engulfing pattern is and how understanding this particular pattern can improve your outcome as a trader. Along with that, we're going to talk about how to master the engulfing pattern trading strategy with a simple twist. How we interpret the engulfing pattern can provide us with a further understanding of the current market sentiment, whatever form it might take. In return, this can help us better assess the probabilities of success behind each individual bearish and bullish engulfing pattern. So let's get started with this thing, and we'll start with an explanation of what the engulfing pattern is, and then we'll step forward and look at the strategy. In technical analysis, the engulfing pattern is a two-candle pattern that can signal a trend reversal or trend continuation depending on where it develops in relation to the prevailing trend. There are two types of engulfing patterns, the bullish engulfing pattern and the bearish engulfing pattern. Being able to identify the engulfing pattern can help us time the market. So how do we identify the bullish engulfing pattern? The bullish engulfing pattern is a combination of one bearish candlestick followed by a bullish candlestick that engulfs the entire body and wicks of the first candle. Naturally, it signals a potential reversal of the prevailing trend. Of course, the bearish engulfing pattern is the opposite of the bullish engulfing pattern. The bearish engulfing pattern can signal the possible start of a new downtrend. While these engulfing patterns do occur in the opposite direction, they are still governed by the same underlying principles. Now we're going to start by looking at how you would typically trade a bearish engulfing pattern. Obviously, the opposite will be true for a bullish engulfing pattern. As per our rules, as the engulfing pattern forms, we first need to wait for the second candle of the price formation to close. A close of the second candle below the low of the first candle shows a stronger bearish signal. Secondly, the engulfing pattern gets confirmed once we break and close below the low of that second candle. Depending on your style, there are two ways you can enter. You can either sell right away when we break below the low, or a more conservative approach would be to wait for the candle close below the low. As a general rule, I recommend the second approach, entering the trade once the pattern is confirmed. Using strict risk management rules, we can put our stop loss above the high of the second candle. It's not unusual with an engulfing pattern to be able to take a 3-to-1 profit to risk ratio. This real-time example outlines why every engulfing pattern needs to be analyzed in the broader market context. Shortly, we're going to take a look at a better way to trade the engulfing pattern, but it's important to understand what's going on behind the scenes. So let's do my favorite thing and look at the psychology behind the engulfing pattern. When we look at raw price action, we can tell who's winning the bulls and the bears battle. The engulfing candle simply signals a big shift in the market sentiment. So let's see what the bullish engulfing pattern is telling us from the supply and demand perspective. The apparent shift in the supply and demand balance is revealed by the second candle, which shows that the buyers have stepped in and managed to overcome the sellers. However, as we know it, the price can move higher from a lack of sellers where the supply side is dried out. That's the reason why you'll see that many times candlestick patterns failing more often than not. The key idea here is that you need to be very selective and only trade the engulfing pattern when it develops at extreme ends of a trend. Truth be told, the engulfing pattern rarely develops at the end of a trend. Most of the time you'll notice this chart pattern popping up a lot in the middle of the trend or in a sideways market where a lot of the price manipulation happens. But what if we can use a strategy to take advantage of the price manipulation? The engulfing pattern is fairly regular in its occurrence. Appearing regularly means that a lot of the time it simply won't work. Statistically speaking, candlestick patterns have a high failure rate, which is why we came up with the idea to fade the engulfing bar pattern. For those of you unfamiliar with that term, fading a pattern typically means going the opposite direction than you would normally anticipate going. Of course, candlesticks can indeed be useful, but advanced trading strategies will require you to look beyond these basic charts and think more deeply. To develop an effective engulfing trading strategy, we need to establish a proper framework to stack the odds in our favor. Step number 1, spot a sideways market. First thing we want to look for is a sideways market where no one is in control. This is very important because it sets the stage for price manipulation. The premise behind the typical price manipulation is based on the core idea that smart money traders need buyers when they want to sell, and they need sellers when they want to buy. So our goal is to identify price areas where the trading volume is flat. Usually in ranging markets, volume remains mostly flat. Since the market is range bound about 75% of the time, it will be easy to spot a sideways market, especially on the intraday charts, which are prone to exhibit more noise. The natural flow of the price dictates that sooner or later we're going to see an expansion in volume, which brings us to the second step. Localize the engulfing pattern. The ranging price action needs to be followed by the engulfing pattern. Going on with our Great British Pound USD chart, we can spot a bullish engulfing pattern. Since we're still in a range, the buyers of the engulfing pattern need to overcome a lot of resistance levels that were built in during the consolidation phase. What happens is that buyers who got tricked into entering the bullish engulfing pattern are now trapped inside a consolidation zone. Now, the first sign that buying the engulfing pattern is a bad idea was that we didn't have enough profit margins. Smart money loves to create these types of price deceptions. How these price deceptions work is very simple. The smart money needs to create a sudden price movement so that it attracts the retail eye to enter the market. Once the retail trader bites the bullet, smart money only needs now to bid the market lower and cause everyone to panic. This in return will trigger more sell stops on the downside, and subsequently the downside move gets amplified. Now, you might be asking yourself, why all the fuss to trick the retail traders? Well, it comes down to two things. Number one, the market is a zero-sum game, so every transaction needs to have a counterparty. And secondly, smart money needs liquidity to execute their big trade. Now, you get the idea why smart money can use the textbook patterns to trick the retail traders. Now let's establish how the engulfing trade strategy works. We have a clear signal to enter the market when the price breaks below the low of the bullish engulfing pattern. Normally traders would buy at the break of the high, so we're doing the exact opposite. Once the price deception is complete, we can see smart money selling aggressively. As a general rule, once we break the low of the bullish engulfing pattern, we should see momentum picking up to the downside. If we see this type of price behavior, we're almost sure we have got a good trade. The next step is to establish how to manage risk. The stop loss strategy is quite simple. We put our protective stop loss above the bullish engulfing bar. If this indeed was a price manipulation set by the smart money, then the price should not break above the bullish engulfing candle high. However, since we can't be 100% in control of what the market does, in the eventuality it breaks above the high, we want to get out, which is the stop loss order's job to do for us. Now, in terms of take profit, if you want to take your trading to the highest point of success, you need to be able to maximize your profits with each trading opportunity. The good news is that our take profit strategy is quite easy to implement. You'll have to take profits along the way and scale out of your position as the trend matures. This ensures you'll benefit from the entire price move. In summary, the engulfing pattern trading strategy gives you a chance to trade along with the smart money and profit from trapped retail traders. Most traders will lose money when trading candlestick patterns, but with a little bit of a twist, you can turn the odds in your favor. And that's precisely what our easy guide to trading the engulfing pattern is aiming for. Here's a summary of what you need to know. The textbook engulfing pattern and how it works, how to interpret the price manipulation around the engulfing bar, how to trade along with the smart money, how to fade the engulfing pattern that develops inside a sideways market, and how to maximize your profits by scaling out of your position. And that's it for this week's trading strategy. Be sure to come back next Wednesday at 3 p.m. as we discuss the MACD indicator in our trading education series. Don't miss my trading picks of the week on Mondays and my strategy of the week on Friday right here on Trading Strategy Guides YouTube channel at 3 p.m. New York time. Let me take this opportunity to say Happy New Year to everyone. Be sure to subscribe and hit the bell so you'll be notified when these videos come out. Have a great weekend, and I'll see you with a couple of trade picks on Monday.